Welcome back to Money Made Easy, your trusted guide to navigating the often complex world of finance. Today, we're going to take a step back, zoom out from the daily market noise, and gain a crucial long-term perspective on wealth building. We're going to explore a fundamental truth about investing, a truth that often gets lost in the whirlwind of news cycles, expert opinions, and the constant pressure to do something with our money. Think about it. How often are we bombarded with information about the latest hot stock, the next market crash, or the must-have investment strategy of the moment? It's a relentless barrage that can leave even seasoned investors feeling overwhelmed and uncertain. But what if I told you that the path to genuine wealth accumulation doesn't necessarily require constant tinkering, expert-level knowledge, or trying to time the market perfectly? What if the key lies in a simpler, more patient approach? To illustrate this powerful concept, I want to share a story, a personal anecdote that highlights the remarkable potential of long-term, consistent investing in the underlying strength of the American economy. Imagine, if you will, a time of immense global uncertainty, a period when the headlines were filled with fear and the future seemed anything but bright. Picture the date, March 11, 1942. The United States had recently entered World War II and was facing significant setbacks in the Pacific. Newspaper headlines were grim, painting a picture of a nation in peril. The stock market, reflecting this uncertainty, had taken a significant downturn. Amidst this backdrop of fear and anxiety, a young investor, armed with limited capital, accumulated over several years, made a seemingly counterintuitive decision. Despite the negative news and market volatility, he chose to invest in American business. Please remember that the information provided in this video is for educational and informational purposes only and should not be considered financial advice. Investing in the stock market involves risk, and past performance is not indicative of future results. The historical examples discussed are for illustrative purposes and should not be interpreted as a guarantee of similar outcomes in the future. Always conduct your own thorough research and consult with qualified financial professionals before making any investment decisions. This young investor, let's call him our historical guide for today, decided to allocate his modest savings to purchase 3 shares of a preferred stock. The very next day, the stock market experienced a significant drop, and his initial investment immediately showed a loss. It was, in his own words, characteristic of his often less than perfect timing in the short term. However, what happened over the long term tells a far more compelling story. Despite the ongoing war and the initial market turbulence, American industry, fueled by innovation, resilience, and the inherent strength of the nation's economic engine, continued to grow. Years passed, and the stock that our young investor had purchased at around $38 per share eventually thrived, ultimately being called by the issuing company for over $200 per share. While our young investor, in his youthful impatience, sold his shares for a small profit relatively early on, the underlying principle remains incredibly powerful. Now let's fast forward from that period of wartime uncertainty to today. Imagine that instead of those 3 shares, an individual had invested a more substantial sum, say $10,000. On that very same day, March 11, 1942, and instead of trying to pick individual stocks or time the market, this hypothetical investor adopted a simple, long-term strategy, investing in a broad representation of American businesses, essentially mirroring the performance of the S&P 500 index. This concept of broad diversification is key to long-term wealth building, as it mitigates the risk associated with individual company performance. Think for a moment about the power of this buy and hold philosophy. This investor wouldn't have needed to become a Wall Street guru constantly analyzing financial statements or glued to daily stock quotes. Their strategy would have been rooted in a fundamental belief in the long-term growth and prosperity of the American economy. Just like buying a farm and focusing on its long-term output, or purchasing an apartment building and looking at its consistent rental income, this approach to investing focuses on the enduring productivity and value creation of American businesses. Now, consider the potential outcome of this patient, long-term investment. If that $10,000 had been invested in an S&P 500 index fund, even though index funds weren't readily available then, the concept of owning a slice of American business was, and left untouched, reinvesting dividends, and weathering the inevitable market ups and downs? How much do you think it would be worth today? Take a moment to let that number sink in. The answer, as history has shown us, is truly astounding. That initial $10,000 investment is held consistently through decades of economic growth, innovation, and the inherent dynamism of American enterprise would have grown to approximately $51 million today. Yes, you heard that right. $51 million. And this remarkable growth would have occurred without any active trading, without the stress of trying to predict market movements, and without the need for extensive financial expertise. It simply required a long-term perspective and unwavering faith in the underlying strength of the American economy. Contrast this with another investment strategy that often gains traction during times of uncertainty: gold. Imagine that instead of investing in American businesses, our hypothetical investor had used that same $10,000 to purchase gold in March 1942 at the prevailing prices that some would have bought approximately 300 ounces of gold. Now, let's consider the long-term outcome of this investment in a non-productive asset. While the businesses represented in the S&P 500 were reinvesting their earnings, developing new technologies, expanding their operations, and ultimately generating more wealth, those 300 ounces of gold would have simply remained 300 ounces of gold. It wouldn't have produced any additional income, created new value, or contributed to economic growth. It would have sat inert, a store of value, perhaps, but not a generator of wealth. Today, those 300 ounces of gold would be worth approximately $400,000. While that's certainly an increase from the initial $10,000, the difference compared to the $51 million generated by investing in productive American businesses is staggering. For every dollar gained by investing in the broad market, the investment in gold would have yielded less than a penny. This stark comparison highlights the fundamental difference between investing in assets that create value and simply storing value in non-productive assets, especially over the long term. The lesson here is profound. The American economy, despite its inevitable cycles of growth and recession, has proven to be an incredible engine of wealth creation over the long haul. By owning a diversified slice of this economy through vehicles like index funds, individual investors have historically had a powerful tailwind at their backs. You see, building wealth over the long term doesn't have to be overly complicated or require constant intervention. It's about understanding the fundamental drivers of economic growth and aligning your investments with that long-term trajectory. It's about having a philosophy rooted in patience and a belief in the power of compounding. Think about the implications of this simple long-term approach. You wouldn't need to obsess over daily market fluctuations, get swayed by every piece of news, or feel compelled to constantly buy and sell based on short-term predictions. You wouldn't need to pay hefty fees to investment advisors for actively managing your portfolio, often with results that fail to beat the market over the long run. In fact, if everyone followed this simple advice of consistently investing in a broad market index and holding for the long term, a significant portion of the financial industry built on active trading and market timing might look very different. While financial professionals play a vital role in providing guidance and planning, the core principle of long-term, diversified investing remains a powerful and often overlooked path to wealth accumulation for the average investor. The key takeaway here is to develop a long-term investment philosophy that you understand and can stick with, even during periods of market volatility. Focus on the enduring potential of the overall economy rather than trying to chase short-term gains or predict the next market fad. Forget about trying to time the market. History has repeatedly shown that this is a losing game for most individual investors. Resist the urge to constantly tinker with your portfolio based on fear or greed. What truly matters in a lifetime of investing is having a well-defined philosophy. It's understanding why you're invested and then having the discipline to stay the course. You don't need to be an expert in accounting, stock market jargon, or the intricacies of Federal Reserve policy. What you need is a long-term perspective and the fortitude to ride out the inevitable market cycles. What are your thoughts on this long-term perspective on wealth building? Have you adopted a similar buy and hold strategy? Or are you more actively involved in managing your investments? Share your experiences and insights in the comments below. Let's learn from each other and build a community of informed and patient investors. If you found this historical perspective and the principles of long-term investing valuable, please give this video a like and subscribe to Money Made Easy. For more straightforward and empowering insights into building your financial future, your support helps us continue to share these crucial lessons. Thank you for watching, and I'll see you in the next video.